Closing Bell. I'm Sarah Eisen in today for Kelly Evans at the New York Stock Exchange. No place I'd rather be on Friday afternoon.
We love having you here on the Friday before Memorial Day. I'm Bill Griffith. Stocks are paring their losses after Fed Chair Janet Yellen said that she expects to raise interest rates this year if the economy continues improving. That's the big caveat. Remember, any positive close, by the way, for the S&P will be a new all-time high. We're not there yet, though.
And we have been seeing it happen all week long, pretty much. The NASDAQ, meanwhile, the outperformer, trying to close at its own record high. The number to beat, 5,092 and change. It's been nearly a month since the index actually ended in uncharted territory. We've got much more on the NASDAQ and on the Fed's rate hike strategy and the markets, including which stocks are set to heat up this summer.
Yes,
it's almost summer now.
It officially begins this weekend. But the real feature today is what?
The dollar.
And what's going on with the dollar?
The first up week for the U.S. dollar against the euro in 5. That's the real story.
We're going to get you your own show on CNBC one of these days. Just call it The Dollar and You.
Don't tease me, Bill. There it is, the dollar actually making a move. And really, it is up 1% after Janet Yellen. It's one of the places where you actually have seen the biggest reaction.
A move, yes, of some kind. Let's talk about it. In our closing bell exchange for this Friday, back with us, Kathy Jones from Charles Schwab, who's with us here at the big board, Gerard Fitzpatrick from Russell Investments, Ken Mahoney from Mahoney Asset Management, also with us here at the New York Stock Exchange, and our own Rick Santelli checking in from Chicago. Kathy Jones, I was joking earlier that it just felt like Janet Yellen was just reading the excerpts from the latest beige book. I mean, when you look at how the market responded, the dollar notwithstanding, you didn't get a whole lot out of this, did you?
I think she just reiterated what we already know, and that is that the Fed intends to raise rates this year. We think they'll probably start in September, and that as long as the economy is doing well, they're going to take a gradual approach, which, you know, I think is pretty well baked into the market already.
Are we there yet? I mean, what has to happen for us to be there so they can start raising rates, do you think?
I think we're probably there. Again, I think the big concern for them is a communication strategy. They want to avoid another taper tantrum. But, you know, unemployment has fallen, and even though the economy was slow in the first quarter, they've dismissed that as transitory. They believe it'll pick up again. But I think what it indicates is this new growth rate of 2 to 2.5% is all they expect. We're not going back probably to 3+ growth rate. And that implies that rates will stay down lower, at least, than they have been in previous cycles.
Rick Santelli, perhaps a bigger market mover, was the inflation report that came out earlier this morning. Saw yields tick up as well as the dollar on that. Some of the stocks sold off. Is that what you guys are talking about out there in Chicago?
Yeah, definitely. That was the big piece. And the other thing that was kind of missing today was a little flexibility. Many traders on this floor, who, by the way, left early in the foreign exchange and interest rate complex with open outcry closing at 1 Eastern, thought that Janet Yellen, 4.5 hours after what was the hottest core CPI rate going back to August 2011, could have mentioned it, even if being on the road, she didn't have all the dots connected, but not to mention it at all, and then make a comment in her speech that was, you know, keeping developments in economic activity and inflation, keeping us up on those as they occur, but really disappointed traders to some extent. As for what's going on in the marketplace, there was a lot of volatility in the market, obviously at 8:30 Eastern. There was a lot of volatility when Janet Yellen started her speech at 1 Eastern. But traders had been on the wrong side most of the week. They were looking to buy back some shorts. Rates were spending time under 217 for about 24 hours. And to think that interest rates still closed up on the day and on the week was kind of surprising considering that bias.
Ken Mahoney, last time you were on, we talked about the lack of volatility, the decline in the VIX. The VIX today is now below 12. It's sitting right on it. It was below it earlier. Just for fun.
That's the lowest of the year.
Well, and I looked up, what do you think the all-time low for the VIX is?
Probably right around here, about 11.5 or so.
It's
single digit?
All-time low is 939. Wow. Set back in 1993.
It's pretty amazing. You know, traders are frustrated by this low volatility. You know, they're not getting the movement. They're not getting the volume that you would like to see, like in fresh breakouts. But for investors, they gotta love this low volatility, this kind of grind higher, so to speak. And we've been saying on this for the last couple of years, you know, buy the dip, sell the rip. Now, when do you sell that rip? Well, we're going to key in on the VIX, the volatility index. Now, something will happen and the VIX will shoot up. And that'll be our key. That'll be risk off again, and we'll take some chips off the table. But while the volatility is low, a trend's your friend. We'll stay with that. We'll stay with that trade. We'll stay long. And for investors, kind of this low beta feeling, we accept this.
It does feel like the calm before the storm, Gerard. And you say in your notes you still believe there could be another shoe to drop in the bond market. What do you mean by that?
Yeah, I think it's like the taper tantrum that we've seen last year. We've seen the bond sell-off earlier this year. But you put that into perspective, that happened before the Fed started increasing rates. We certainly expect that the Fed would increase rates from September of this year. I think today, Chairperson Yellen had the opportunity to make a pause and be somewhat consistent with the market. She didn't. She clearly pointed that employment's on track and inflation is on track, and hikes are very likely this year. So with that, we believe that the hikes will occur in September. And with a pretty fragile market sentiment out there amongst bond investors, that's the potential for the next shoe to drop. In other words, another type of taper tantrum or another increase in yields. So with that, we're positioned to be relatively short interest rate duration in our portfolios at the moment.
Kathy, the minutes from the April meeting suggested that the Fed, I don't want to say they're fearful, but they're mindful of what could happen when they do raise rates that first time, that we could see that proverbial taper tantrum like we saw a few years ago. Do you think that's what's going to happen?
Well, I think there'll be a fair amount of volatility, but I doubt it because they've been so clear about what their intentions are. So if you haven't heard that the plan is to raise interest rates, you haven't been awake for about a year now. I think the most likely scenario, though, is if the Fed is raising rates and the dollar continues to appreciate, that's going to hold down inflation. And we could see more of a flattening of the yield curve than anything else. And it certainly could give us a lot of volatility in the short run. But I'm not sure it's going to give us what we had in the taper tantrum, which was a parallel shift in the yield curve. I doubt that happens this time.
Yeah, the markets really look forward to it. I mean, we really should start normalizing rates. From 0 to 0.25%, there's not much the Fed can do. You want to get some arrows in the quiver, raise rates a bit, so next time the economy falters, they have something to work with. So I think the market will eventually accept higher rates, and the economy can actually still perform with a little bit higher Fed fund rates, in the anticipation that the next cycle that goes down, the Fed will have something to work with to be able to cut rates at some point.
Gerard, you see that in financials, which are the outperformers in today's session on that view of higher interest rates. Is that a good thing that those are the leaders in this session on higher rates?
Well, a concern I'd have with financials is the potential for that yield curve to flatten, the expectation of rising rates, particularly in the short end. We see the curve flattening, and with that, we see it being relatively negative for those net interest margins facing banks. You also combine that with where we are in the credit cycle, we see some more default risk coming through. So a flatter yield curve and rising credit risk, that could be relatively negative for banks. So I'd be cautious on financials, particularly after an increase in valuations.
Interesting.
Hey, Rick, I'll ask Sarah's question, but if the dollar is having its first positive week in a while, do you think we're getting ready to resume the rally that started earlier this year, where everybody was thinking we were going to get parity against the euro?
Listen, if we take the Fed at its word, and that does get very difficult, but if we take the Fed at its word, the dollar is idling, getting ready for another moonshot, in my opinion, specifically about the issue of raising rates and normalization. But do keep in mind that there's a lot of issues that the Fed has that are highly, highly, highly subjective, not objective. We are running in to tweak GDP, but we overlook other things. The Fed is looking for reason, many traders think, to raise rates. And I'm not sure that the market is ready for that ideal time, because it's not about the glide path if you hold a portfolio. It is about when it occurs. With glide path is almost the easiest thing at this point. Right. One and done or raising rates slowly, I think people get that. The date it happens, well, I want to see what date it does happen and see whose portfolios are ready for it to happen.
So, Kathy, we can talk about what the Fed's going to do or not this whole time, but really it comes down to the data. That's what they're telling us. That's what's going to depend on whether this dollar can continue, as Rick says, another moonshot kind of move. Is the data telling you anything clearly? In other words, are you seeing enough confirmation that the first quarter slump is behind us and we can recover?
Well, we really haven't seen a lot of good economic data since since the end of the first quarter. It's been pretty soft, but the employment side looks pretty good, and the inflation indicators are starting to turn up a little bit, and housing activity has picked up a bit, and that's kind of been the last thing that needs to pick up in the cycle. So it's probably good enough. It's not good, but it's good enough.
Ken Mahoney, where are you going to make money right now?
We still like equities here, and to her point, it's, you know, this choppy economic data reminds me of a Seinfeld episode where Jerry plays Even Steven. He gets good news in the morning, and it's offset by bad news in the afternoon. And for investors, we've been dealing with this choppy economic news, much like that Seinfeld episode, getting good news in the morning, and then in the afternoon, looks like we're not getting any traction. But I would just kind of stay long equities. We like domestic. Again, we're going to watch that VIX very closely. If that spikes, we'll take some money off the table. But mostly broadly, ETFs. Domestic, mid to large cap is kind of our sweet spot right now, recognizing the choppy economic data that we're going to have to deal with.
Well, Bill, I know you guys have been all over the transports this week.
Yes.
They're actually set for their worst week since the end of March.
Right.
And the question is that a worrisome signal?
Is that a worrisome signal? I mean, that's an incredibly important part of the economy as well. Well, you guys are playing Even Steven, but it's clear that nobody's the master of their own domain in this market right now.
That's right.
Thank you very much. Have a good weekend, everybody.
Okay.
Good long weekend. See you later.